$7,200 every single year. And most retired Americans have no idea this is happening to them. That number is not random. It is not a scare tactic. It is the average amount retirees lose every year because of a connection most people never learn about. The connection between the IRS and Medicare. Two agencies, two separate bills, one hidden link that legally pulls money from your retirement the moment you turn 65. And if you are watching this right now, there is a good chance it is already happening to you. You worked for decades, you paid into the system, you played by the rules, and now that you are finally retired or getting close to it, you probably assumed the hard part was over. You thought taxes would be simpler. You thought Medicare would just be a benefit you earned. Nobody sat you down and explained that what you report to the IRS in April can change what Medicare charges you the following January. Nobody told you these two systems are talking to each other behind the scenes. That is not an accident. That is just how the system works. And the people who understand it pay less. The people who do not understand it pay more, every single year. Here is why this matters specifically to you. If you are between 60 and 72 years old, you are either entering this window or living inside it right now. Your income sources have changed. You may be drawing Social Security. You may be pulling from a traditional IRA or a 401k. You may have investment income. Each one of those sources feeds the IRS a number, and the IRS passes that number to Medicare. Medicare then uses that number to decide how much you pay for health coverage. The higher your reported income, the more you pay. And the trap is this: the income they are looking at is not from last month. It is from 2 years ago. That is the part that catches people completely off guard. Let me make the stakes very clear before we go any further. This is not a minor issue. This is not something you can fix later without cost. The IRS has legal authority over your retirement income in ways most people never fully understand. And if you are not paying attention, the rules can work against you silently, year after year. Here is what the IRS can legally do to retirees. First, the IRS can require you to include up to 85% of your Social Security benefits as taxable income. This is not new, but most people still do not realize it applies to them. It is calculated using something called combined income, which is your adjusted gross income plus any non-taxable interest plus half of your Social Security benefits. If that number crosses certain thresholds, $32,000 for married couples filing jointly, $25,000 for single filers, a portion of your Social Security becomes taxable. The rule comes from Internal Revenue Code Section 86. It has been on the books since 1984. But surveys consistently show that more than half of Social Security recipients are caught off guard by it the first time it hits their return. Second, the IRS can trigger what is known as a required minimum distribution, or RMD, starting at age 73. This is governed by Internal Revenue Code Section 401A9. If you have money sitting in a traditional IRA or a 401k, the IRS does not let that money sit there forever untaxed. They require you to start pulling it out and paying taxes on it, on a schedule they control. The amount you are required to withdraw is based on your account balance and your life expectancy, as calculated by IRS Publication 590. If you miss an RMD, the penalty is 25% of the amount you were supposed to withdraw. That penalty was reduced from 50% in 2023 under the Secure 2.0 Act, but it is still severe. And here's what makes it worse. That forced withdrawal becomes part of your reported income, and that reported income flows directly into the Medicare calculation. Third, the IRS can disqualify certain deductions and credits if your income crosses specific thresholds. The medical expense deduction, for example, only allows you to deduct the amount that exceeds 7.5% of your adjusted gross income. So if your income is higher than it needs to be, because of an unplanned IRA withdrawal or a one-time capital gain, you lose deductions that could have lowered your tax bill. Every dollar of unnecessary income has a ripple effect. It increases your taxes. It raises your Medicare premium. It reduces your deductions. The damage compounds. Most people do not know this because no single agency ever explains the full picture. The IRS sends you tax forms and instructions. Medicare sends you a premium notice. Social Security sends you a benefit statement. But none of these agencies are required to explain how their systems interact with each other. And most financial advisors focus on investments and returns, not on the tax and premium implications of how those investments are structured or when money is withdrawn. This information is not technically secret. It is just scattered. It is buried in IRS publications, Medicare fact sheets, and Social Security Administration documents that most people never read. And because it is never explained in plain language, most retirees do not find out about it until they have already been hit by it. There is even a name for this Medicare penalty. It is called IRMA, the Income-Related Monthly Adjustment Amount. Most people have never heard of it until they see it on their Medicare bill. And by the time they see it, the income that triggered it is already 2 years in the past. There is nothing they can do about it retroactively. That is the trap. Now let us go deeper. Here is the core of what you need to understand. We are going to cover 3 specific areas: how IRMA works and what it actually costs, how Social Security taxation and IRMA stack on top of each other, and how RMDs create a tax spiral that most people never see coming. The first area is IRMA, what it is and what it actually costs you. Medicare Part B covers doctor visits, outpatient care, and preventive services. In 2025, the standard Part B premium is $174.70 per month. That is the baseline. But if your income is above a certain level, Medicare adds a surcharge on top of that baseline. That surcharge is IRMA. The income threshold for a single filer is $106,000. For married couples filing jointly, it is $212,000. If your reported income exceeds those amounts, you immediately move into the first IRMA tier. Your Part B premium jumps to $244.60 per month. That is a surcharge of roughly $840 per year, and it gets steeper from there. At higher income tiers, the monthly premium can reach $588.50. That is more than $6,000 per year for Part B alone. And IRMA also applies to Part D, which is your prescription drug coverage. The additional Part D surcharge ranges from $13.70 to $76.40 per month, on top of whatever your plan already costs. When you add Part B and Part D surcharges together, a retiree in even the first IRMA tier can pay over $1,000 more per year than a retiree just below the threshold. At higher tiers, that excess can exceed $7,000 annually. This is where the $7,200 figure in this video's title comes from. It is not theoretical. It is a real documented outcome for retirees whose income pushes them into the upper IRMA brackets. What should you do about IRMA? You need to know what income level places you in each tier, and you need to plan your withdrawals, conversions, and capital gains carefully, specifically in the years that will become the look-back year for future Medicare premiums. For example, your 2025 Medicare premium is based on your 2023 tax return. That 2-year delay is called the look-back period. If you had a large one-time income event in 2023, a home sale, a large IRA withdrawal, a Roth conversion, that event is currently affecting what you pay for Medicare right now in 2025. If you know a large income event is coming, you need to plan 2 years ahead, not 2 months, 2 years. The second area is the double tax hit, Social Security taxation stacking on top of IRMA. Here is what actually happens when these two systems interact. Let us say you are single. Your adjusted gross income from IRA withdrawals and investment income is $30,000. You also receive $20,000 in Social Security benefits. Your combined income, the number that determines Social Security taxation, is $30,000 plus $10,000, which is half of your Social Security, totaling $40,000. That is above the $25,000 threshold. So 85% of your $20,000 in Social Security, that is $17,000, is now taxable income. You are now being taxed on money you already paid into for decades. And if that same income calculation pushes your total reported income close to or above the IRMA threshold, you now face a Medicare surcharge on top of that Social Security tax. 2 separate systems, 2 separate hits. One income event can trigger both simultaneously. The key action here is to manage your withdrawal timing. If you can keep your combined income below the relevant thresholds, you reduce Social Security taxation and avoid IRMA entirely. Roth conversions done strategically before age 63, 2 years before Medicare eligibility at 65, can help reposition taxable assets into non-taxable ones, which are not counted in the Medicare income calculation. This is not a loophole. This is legal tax planning, allowed by the IRS. The third area is the RMD tax spiral, and how it can push you into every problem at once. Most people do not think about RMDs until they hit age 73. By then, decades of tax-deferred growth may have turned a modest IRA into a significant account. The IRS requires you to withdraw a specific percentage of that account every year based on IRS publication 590 life expectancy tables. In the first year, that required withdrawal could easily be $30,000, $50,000, or more, depending on your account size. That withdrawal counts as ordinary income on your Form 1040. It raises your adjusted gross income. That raises your combined income for Social Security taxation purposes. It pushes more of your Social Security benefits into taxable territory. And if that combined income crosses the IRMA threshold, your Medicare premiums for the following year increase. 1 required withdrawal, 3 financial consequences. The spiral begins. What can you do? If you are currently between 60 and 72, before RMDs begin, you are in what planners call the Roth conversion window. This is legally one of the most powerful tools available to retirees. You can voluntarily convert portions of your traditional IRA into a Roth IRA each year, paying taxes now at potentially lower rates in order to reduce the size of your taxable accounts before RMDs force larger withdrawals later. The conversion amount shows up on Form 8606. The taxes owed are reported on your Form 1040. It is not free. You pay taxes on what you convert. But the tax you pay now may be far less than the compounding cost of IRMA surcharges, Social Security taxation, and large forced withdrawals later. Every year you delay this decision is a year the problem potentially grows. Here is what you need to do. These are not vague suggestions. These are specific, actionable steps that address exactly what this video has covered. Step 1. Pull your last 2 years of tax returns. Look at your adjusted gross income on each return. Compare that number to the IRMA income thresholds, $106,000 for single filers, $212,000 for married couples filing jointly. If you are close to those thresholds, you are at risk. You need to know where you stand before your next major financial decision. Step 2. Request your Social Security earnings and benefit summary by creating an account at ssa.gov. Look at your projected benefit amount. Then calculate your combined income using the formula we discussed. Your adjusted gross income plus non-taxable interest plus half your Social Security. This tells you how much of your benefit is currently taxable. If that number surprises you, it is time to adjust your withdrawal strategy. Step 3. Review your IRA and 401k balances today. Use the IRS RMD worksheets in Publication 590 to estimate what your required minimum distributions will look like starting at age 73. If those projected RMDs will push your income into IRMA territory, and for many retirees they will, you have a limited window to do something about it. The earlier you start partial Roth conversions, the more you reduce the forced withdrawal amounts later. Step 4. If you receive a Medicare premium notice that includes an IRMA surcharge and your income has dropped significantly since the look-back year, for example, you retired or had a one-time income event that will not repeat, you can file an appeal using Form SSA 44. This form is called the Medicare Income-Related Monthly Adjustment Amount Life-Changing Event Form. It allows you to request a reassessment based on your current income rather than your 2-year look-back income. This appeal is legal. It is available to you by law, and most people never use it because they do not know it exists. Step 5. Before the end of each calendar year, specifically before December 31st, review your projected income for the year and compare it against both the Social Security taxation thresholds and the IRMA thresholds. If you have room below the threshold, you may be able to make an additional Roth conversion without crossing into a higher cost bracket. If you are already near the threshold, you may want to delay a withdrawal or reduce a discretionary sale to stay below the line. This type of year-end review, done every single year, is one of the most legally powerful moves a retiree can make. You now know something most retired Americans do not. You know that the IRS and Medicare are connected. You know that your tax return is not just a tax document, it is the number that determines what you pay for healthcare for the next 2 years. You know that Social Security benefits are taxable under certain conditions, that RMDs can trigger a spiral of compounding costs, and that there is a legal appeal process available if your Medicare premium reflects income that no longer represents your financial reality. This information exists in IRS publications and Medicare guidance documents, but it is never explained this clearly, and it is almost never explained to you before the damage is done. If you found this useful, subscribe. Every week I cover what the IRS expects from retirees, the rules most advisors never explain.